investing, it's fun, it's exciting. Jim Cramer comes on TV and he pounds his buzzer. I think he used to bite the head off the bull from time to time, or the bear, or whatever it was. You have seen places where a stock's been up 20% in a day. Your neighbor tells you that they made X dollars on such and such a stock. It is, it's a drug, right? I mean, it really is. It's kind of sort of like gambling when you think about it in the short term and the emotions that get wrapped up into it. And we've got two extreme cases, and it's just worth reciting those or revisiting those, right? So at Portus, we do we have four different main portfolios that are fully diversified, right? Equities, international equities, small cap equities, fixed income, cash, like all the works. And then we also have what we internally, because we're bad marketing folks, we have what we call a sleeve of stocks, which is 20 individual stocks. And they're equally weighted, right? Generally speaking, they're about 5% of the portfolio. 5 times 20 is 100. And we've got young folks that are in it, right? Because their time horizon is longer, they can take more volatility. And it's a way for us to kind of get people to understand what that is. And usually we'll put the sleeve of stocks next to a couple of portfolios that are more diversified, but the sleeve of stocks is a beneficial education piece for us. And so I had a phone call a couple weeks ago, and the sleeve of stocks is down at that point in time, is probably down 8% from its peak. And the client was like, we need to do something. It's like, okay, well, what do we need to do? I was like, what's changed? And he was like, well, the stocks that we own in there, they're just not doing well anymore. He's like, I think we should own some different things in there. It's like, okay, well, I mean, this is a valid point, but what are we owning different things for? He's like, well, so they'll do better. I was like, well, yeah, I mean, I get it. I mean, we've had a sell-off in some financial markets over the course of the last couple of weeks, but that doesn't change the underlying nature of some of the holdings. And so we went through the holdings and what they were, why they were diversified, and what their intent and structure was, and why we might make changes and why we might not make changes. He's like, yeah, but what about these other things that are doing really well? I was like, they're doing really well right now, but they might not do well for, forever. And then are we going to sell those and buy something? It's like, how are we constantly, as like we make decisions with 2 to 5 year lens. Now, sometimes that 2 to 5 year lens changes. And sure enough, so a couple weeks pass and the portfolio is back to where it was. The stocks that he had wanted to potentially add into the sleeve of stocks are no longer doing what, he had thought they were going to do forever. And so it's just constantly chasing the next hot thing, right? We're paying attention to the markets, but when we're investing versus gambling, what we're thinking about is making longer term decisions, not shorter term decisions. Short term decisions, we make a lot of short term decisions. It's very hard to make a lot of good short term decisions. And so, same thing. We had a client email last week, and they're hot and heavy now for SpaceX. And I mean, yes, of course, we can buy SpaceX, right? But it's that emotional component of SpaceX was at 205, then it went to 105, now it's back to 140. I'm going to miss it if I don't get on board. Maybe. But what are we getting on board for? What's the reality of the situation? What's our time horizon, right? Is this really something that are we chasing because we just want to win because we think other people are winning and we're not? Or are we making an investment decision? Is there an investment thesis behind it over the course of the next, hopefully 6, 12, 24, 60 months, right? And so just remember as you're paying attention to the financial markets, short-term decisions are very hard to stack on top of each other and create a winning strategy. It's usually longer-term decisions that end up winning, right? You go back and, I mean, I know you've got all kinds of hedge funds that do X, Y, and Z, but a lot of times those hedge funds make money because they're charging 2 and 20, right? They make big bets, their bets win, and then you'll pay attention. Their bets are wrong for many, many years. And so they made all their money on one bet, not on each subsequent bet that came after it because they kind of got that tunnel vision. So as you're thinking about investing, remember tunnel vision bad, broader vision good. Don't chase. Don't worry about what your friends are doing, right? It goes back to why are we doing this? And how do we execute to get what we're trying to achieve? And then, sure, maybe have a little play account where you go out and you chase returns with your friends or something like that. But that's off to the side. I always say that's play money versus serious money. You know, some people's play money bucket is bigger than other people's play money bucket, but let's kind of hold a serious bucket there, and it should be relatively large in terms of percentages to the play bucket. But anyways, just remember, don't chase the returns, make good long-term decisions, not tough short-term decisions. If you liked today's video, hit the subscribe button down below, or better yet, just leave us a comment.